Hey everyone, welcome to our next webinar on the tax implications of investing in property with a special focus on fractional investment into property companies. This is our third webinar in the series. On the call is Fred King. Hi Fred.
Hi Vince.
Good. Guys, we're just going to give everyone 2 minutes to start. So we'll start the webinar in 2 minutes past 1. Just in preparation for that, those of you who have joined already, we've launched our co-ownership offering, which is the reason why we're putting out a lot of this content out. Is we're wanting people to be informed about tax implications, how this property process works with us, how investment works with us, but then also for your benefit, if you're looking to invest in property elsewhere or you have property already, this will be helpful for you in terms of understanding the tax implications. And then our next webinar in this series, we're going to be switching it up a little bit. We're going to be launching a webinar called Live Like a Local, where we're going to take you through an insider's guide to what living in Cape Town is about to maximize your next stay in Cape Town and do all the things that locals do. We'll have our Neighbourgood team on that webinar, as well as the team from Local Knowledge. We've been working closely with them for some exciting stuff to come over season. And that'll be a really, really cool one for you guys to join if you can. That'll take place on the 7th of September at 1 p.m. South African time. We'll send out a link for the registration. It has gone out with our newsletter. If you haven't got it, you can more than welcome to pop me a message, and I'll get back to you with the details. Just posted in the chat as well. For those of you who do want to book a call with our investment team, you haven't had a call, there is a link to book a call with us, and my contact details are in the chat as well. Please also post, if you are on the chat, please post where you're calling in from. We'd love to know for all our digital nomad and remote workers out there. We're hoping you calling in from some tropical island somewhere or a nice warm summer destination. Yeah, in Cape Town, typical Cape Town winter weather. We've had all 4 seasons in one day already. It's not even midway through the day. Great, thanks. If you've just joined now, you will be sent all the registrants will be receiving a copy of the webinar post the webinar. So if you did miss anything previously, we just had some intros and chatting about what our co-ownership offering is about, which you can watch on the recording. Perfect. Guys, so please post your questions in the chat. If anything is unclear, post it in the chat. We'll do our best to answer all the questions we can. If your question is a longer question, or if you need some more information or we don't get to it, we'll contact you directly after the webinar and give you the information that you need. Guys, as I mentioned, Fred King is here with us. Fred is a director and chartered accountant at WeBalance. WeBalance provide tax and accounting services to our property investment companies and to ourselves. And they've been doing this for quite some time, and we've got a strong relationship with WeBalance. Fred, how's it going?
Hi, Sijin. Very well, thanks. Hope your side too. Yeah, so just for the listeners, I'm dialing in from George, which is a small town, probably about 4 hours from Cape Town.
Good. So that's up the garden route, a very, very cool space to be. So if you guys are looking to come to Cape Town again and you're wanting to travel, we do recommend the garden route. Go and see Fred there in George. It's a very green and beautiful place. Cool, guys. Fred's going to run us through the different types of taxes involved with owning and investing in property. Tax is obviously quite a complicated subject. Fred's going to make it nice and simple for us. And, especially for us mere mortals who, don't have our masters in Excel and financial math and all those good things. He'll also run us through how those implications look like for our co-ownership offering and investing into those property companies specifically as well. Although, like I said, the webinar will be applicable to you if you're looking at investing elsewhere in property. It's important to understand the pre and post tax returns and how the different structures will have an impact on your post tax return. And if you have any questions, again, please pop them in the chat. I'll do my best to answer them as we go, or Fred will answer them. And just afterwards, we'll do sort of a recap of the webinar. Perfect. Fred, I think if we can get straight into it if we can.
Yes.
Fred, maybe if you can start just by providing a brief rundown of the different taxes involved in investing with property.
Yes. So firstly, I would just to put a disclaimer that this is not tax advice. We're merely trying to make the understanding of tax a bit better. So basically, we've got 3 different types of taxes applicable to this scenario, which will be income tax, capital gains tax, and dividends tax. Starting with income tax, if I can take you through the different structures. So a company, it's got its own income tax. It's taxed at 27%. You get taxed on your income, which is you generate income. Let's say in a property company, you get rental income. Then you've got expenses that you can deduct against that income, being rates and taxes, your electricity bills, etc. That would then bring you to a taxable income, and that taxable income then get taxed at 27% in South Africa. So that's for a company. An individual on income tax, that would be you'll pay income tax on your salary. Let's say you've got some personal investments that generate interest or dividends. So dividends, let's keep that aside. Let's only look at salary and interest. So that would also be subject to income tax. So income tax for individuals in South Africa they get taxed in specific scales, and we'll touch on that a bit later. Then looking at capital gains tax, that's the taxes we pay on capital assets that we own, that we sell down the line. So there's a great distinction to do between whether you are owning a capital asset or whether this is an income that you're busy looking at. So let's make it easy. You own a property, whether that is individual or company, and you sell that property off. That would attract the capital gain. And then dividends tax.
Fred, sorry, just for everyone in terms of attracting a capital gain. So essentially you buy the property for 100 Rand, it's worth 150 Rand, in 2 years' time, or whatever the case is. I'm just using simple figures to illustrate it. The capital gain that you've achieved is essentially the 50 Rand difference, right? Between what you paid for it and then the capital improvements which you've spent on it, and then the difference between those two and the selling price at the end of the day is your capital gain, correct?
Correct, yes. So we can maybe run through the numbers that we see on the screen now. Then I'll deal with dividend tax when we get there. So looking at this specific example, let's say you purchase a property for 400 Rand. You made improvements to that property of another 100 Rand, meaning you've spent on this property 500 Rand. Now you're keeping this property as a capital asset, and then 2 years down the line, you're selling it for 800 Rand, meaning you've realized a profit of 300 Rand. So that profit then need to end up in your income tax. So how that happens is, for capital gains tax for individuals, only 40% of that 300 Rand profit will end up in your income tax. Then for trusts and companies, that percentage is 80%. So if we look at the example here, capital gains tax is not taxed at a specific rate. It ends up in your income tax. So in the end, you pay income tax, which would include the capital gain that you realized. So let's see this 300 Rand that we made in this example, 40% thereof is 120. So looking at the individual to the right, you'll see that individual, this is just for example purposes, he had a salary income, rental income, and then the capital gain gets included in there. That brings them to their total taxable income, and that would then be subject to the tax scales from SARS. If I can quickly show you, since you're welcome to just jump in where you think we need to cover more.
Perfect. I think, Fred, yeah, if you can maybe we'll just quickly go through the tax tables. I think most people understand sort of, where their taxable income sits, but we can go through that. And then I think, Fred, it's important, sorry to interrupt you there, Fred. It's just important, I think, also to just chat about, in terms of the taxable income, what expenses, in terms of that property come off the rental income, even if it's in your personal capacity. You've got the operating costs of running that property, and then the interest on the bond or loan repayments for the property that can be tax deductible. So maybe you can just chat us through, tell us about that, and then the tax table.
Yes. So let's say you own a property, whether it's in your individual name or in a company. You'll be earning rental income. That would be your income. Then your expenses, you can deduct expenses that you incurred to generate that income. So for a property company or property you own, that would be your rates and taxes. If you've got a bond on the property, only the finance cost each month can be used as the deduction against that income, not the full repayment of the bond, only the interest portion. Any operational cost that you incur that you'll be able to substantiate for generating that rental income can be deducted. That's your accounting fees, your bank charges, electricity. Maybe you've got some repairs and maintenance on this property. Everything that you incur, you can deduct as expenses, and then your profit after that will be subject to tax.
Perfect. But none of those operating expenses will be included in your capital gain, correct? The capital gain, in terms of the previous one, is sort of capital improvements that you make to increase the value of the property, which is obviously treated in terms of the capital gains tax calculation.
Correct. Yes. So it would be, the capital.
Johan's just posted in the chat that the renovations will be capital gain, correct? So any renovations where you've improved the property will be a capital gain, a capital expense, and any operating cost like a repair and maintenance. So if you're just repairing what was there before or maintaining what was there before, that'll be an operating expense and not a capital expense.
As soon as you're starting to improve the property, that would go to the capital side. So there's always that great distinction that you need to do in your repairs and maintenance account, whether was this in fact repairs and maintenance or did I improve my property, which would then take it to the capital side. And all your improvements obviously get added to your purchase price for when you need to sell off that property one day. That's basically for income for individuals and companies. Just touching quickly on trust, as trust is a bit more complicated. So for a trust, the inclusion rate of that capital gain, going to the example again, that 300 Rand would also be 240. So you'll see there in the trust, again, some income expenses, and then the capital gain gets included in there for 240. Just for a trust can distribute its profits to its beneficiaries, and the beneficiaries will then be liable for the tax on that income. So trust is a conduit principle. So if we put rental profits in at the top, whatever gets then it will be rental profits being distributed to the beneficiaries as well. So the nature of that income will stay the same, and then obviously we'll revert back to the individual if that income is distributed to the individual. So then the individual tax rates will apply again. It's very seldom that we do tax income in a trust due to the high tax rates. So you'll see a trust get taxed at 45% on the income. Sinji, do you think that's understandable?
I think it's pretty understandable. I mean, everyone will obviously receive a copy of this as well, so they can go through it in some detail if they've got the time. If they've got any questions, you guys are welcome to ask. If you want to know anything, please, guys, keep us accountable here on the chat. post any comments that you have or message. Anything's unclear or we need to explain something, please pop it there. There are no silly questions here. We want to try and cover as much as we can and add as much value as possible. Perfect, Fred. I think let's move on from here. Let's move on to dividends tax.
Okay, so dividends tax, that's a tax that's only applicable where there's a shareholder relationship, meaning you need to own a share to get into the dividends tax net. So typically investors will own shares in a property, and that property will be owned in a company. Investors will own shares in the company, and the property will be owned by the company. So looking at this example here, starting at the block right at the top, I've got a company there. It's got rental income. Let's say that's a property company. It's got rental income of 950. It's got the expenses that we explained earlier of, let's say, 402 Rand. That gets us to a profit before tax of 548. Then the company needs to pay income tax on that at 27%. It then brings them to a profit after tax of 400 Rand. So that profit after tax in the company is now available for distribution to its shareholders. And that distribution will be done based on the percentage that each shareholder owns of the total shares in issue. So in this example, we have 4 different shareholders, each owning 25% of the share capital, meaning that 400 Rand profit should be distributed 100 Rand to each of the shareholders. Now, that 100 Rand is now subject to dividends tax. So now is the place where we get that, depending on in what structure you own that shares, will make a difference in what tax rate applies on your dividends tax. So if we take shareholder 1, it's a local individual or a local trust. They get treated the same. So their dividend will be taxed at 20%, meaning of that gross dividend of 100 Rand, 20 Rand need to be withheld by the company distributing the dividend. And only 80 Rand will end up in the shareholder's bank account. So dividends tax is a withholding tax, meaning the company's got the obligation to pay that over to SARS. So looking at shareholder 2, that's a local company. So company to company is dividends tax free. So there's no dividends tax if a company issues a dividend to another company, meaning shareholder 2 will get 100 Rand in their bank account. Then we've got shareholder 3, who's a foreign individual. And this is now where we need to start to look at double tax agreements. So double tax agreements is exactly what the name says. It's making sure that someone sitting in another tax jurisdiction does not pay double tax. So South Africa has got agreements with many countries in the world. And for this specific example, I looked at Denmark. So if we just maybe quickly look at this schedule. So the schedule is also available, since you can also make this available to them.
Yes, I'll actually post the links in the chat, and then we can send it as well. There are 2 different links. One is for foreign investors residing in Africa, in other countries other than South Africa, and then the other one will be for globally outside of Africa. So I'll post those links shortly. Fred, yeah. So Fred, from what I understand about this, and maybe just to clarify, so this would be if you're a foreign investor investing into a property here in South Africa, and you were from Denmark, just to use this example, that would be correct, right? In terms of what
yes.
got up here on the screen.
So this document will be showing all of the various countries with whom there are double tax agreements. So looking at Denmark here, we see there are 2 different rates. So the 5% will only be applicable if the shares is held in a company, a foreign company, and at least 25% shareholding. In any other case, we'll revert back to the 15% dividend tax rate. So if we go back to our example here, shareholder 3, who is a foreign individual, owns 25% of the shares. So if we go back here, that individual, so the 5% is only for companies. So that individual will then be in the 15% category. So 15 Rand of that 100 Rand will need to go to SARS as dividends tax. So shareholder 3 will only get 85 Rand in their bank account. So if we look at shareholder 4, shareholder 4 is now a foreign company owning 25% of the shareholding. So shareholder 4 then falls within that first category of the 5% withholding tax. So if we look at the example again, of the 100 Rand, 5 Rand will need to go to SARS and 95 will end up in the foreign company's bank account. So then right at the bottom, I've just indicated in total the flow of this 400 Rand dividend that was declared. 360 thereof ended in the 4 shareholders' bank accounts, and 40 Rand was withheld by the company, and they're paying that over to SARS. So in essence, in a nutshell, that's how the dividend tax structure works. And then that also shows you the implication of if you hold the shares in your personal capacity, whether you hold it in a company, it's basically the dividends tax rate that will differ.
Perfect. Fred, just to highlight that specifically, so obviously in terms of our ownership offering, it's fractional investment into a property holding company which holds the asset, and then we have multiple shareholders in that property holding company, and then we pay those dividends out to the shareholders in terms of a dividend. Just quickly, in terms of what the benefits of why we choose to hold those investments in property companies, why it's what are the benefits of holding property in a company rather than an individual title in your own name? You can just run through those quick.
So a property obviously makes it, a company obviously makes it easier to have many shareholders in one property. And then secondly, a company is a legal entity on its own, meaning it's totally standing on its own. So should anything happen down the line, creditors can only attack the company and the assets owned by that company, but they cannot get their hands on the shareholders because the company is a legal entity on its own.
So there's a limited liability between yourself as the individual and then the company.
Correct. That's that. I think that would be the main things.
Yes. So what we find, so we obviously do it for a number of reasons. The tax structures, although there's no dividends from company to company, and then there's obviously the implication that the company tax rate may be quite different from your individual tax rate, depending on what your taxable income is. So if you have a very high taxable income, you'll be taxed at a fairly high rate relative to the company tax rate. But then there are the complications of if you invest via a company, you do have all the complications of running that company, and people like Fred and his team who do all the compliance for that company and register that company and make sure you're compliant, and you have audited financial statements, and you have the yearly audit, and you have all those resolutions between directors and all the stuff that we do in terms of running our portfolio of properties. So there are all of those implications and costs. So we generally say to people, if they are investing in one property for a small amount, it's not necessarily worth going through all those costs and processes. But if you're looking to grow a portfolio and you in time want to accumulate assets within that company and grow that company's balance sheet, then it makes sense to go through that process. Just on dividends tax here, Fred, we've had 1 or 2 questions. So one of the questions is, if you're a South African citizen, but you're based in the UK, will the DTA still be applicable, the double tax agreement?
So the double tax agreement all depends on your tax residency. So meaning we will need to determine where that person's got a tax number. So someone who's a citizen of South Africa staying in the UK, it all depends whether they've exited the South African tax regime yet or not. Yeah, so that's a bit more complicated. We'll need to look into the details.
Perfect. So from what I understand, Fred, with that is if they're a South African citizen but they're investing as a South African citizen, then the South African dividends withholding tax would apply, right? 20%. But if they're investing as a foreigner from a tax registration in the UK, for example, then they would be able to take advantage of the DTA. We can clarify that,
Correct.
but as
Yes.
far as I understand.
Yes, no, that's correct. So it all
Great.
that's why this double tax agreement won't just kick in by itself. There's a declaration that needs to be completed by each shareholder, and in that declaration, the shareholder will declare, "I'm a tax resident of this country," and yeah, SARS will need to have those documents before they'll apply and be happy with the double tax agreement.
Perfect. To all of our foreign investors who are taking advantage of the DTA for your company, we will have those forms for you, and we'll assist you with completing those forms in terms of if you invest with us. Fred, with another question here is around, and I think it's just more for us to clarify, dividends tax is paid by the company and not again by the individual once the dividend has been distributed. My understanding is Pierre's 100% correct here. It's that the company is responsible to withhold that tax before paying the dividend to the investor and then pays that tax over. So it's not that you pay a dividends tax again as the investor. The only time being that you might, if you invest via a company into the property company, when that company distributes a dividend, there may be a dividend tax payable there in terms of to an individual. Correct? Or
correct? Yes. So Pierre's got it 100%. Your tax return in South Africa do have a field where you need to declare your dividends received, but it won't be included in the taxable income. So they bring it in and then they say this has already been taxed, so we won't include it in your taxable income, but it needs to be declared.
Perfect. Then another question from Yannick is, if the property is bought as an individual in South Africa, so it's a South African property, who signed in two names, one is a foreign individual and one is a South African, how will the taxes work? So individual property, not investing on behalf of a company, two individuals, one's a foreigner, one's a local. Let's assume for this scenario, Yannick, I'm not sure if there's a specific percentage, but let's assume that the asset is owned 50-50 between two individuals.
Yeah. So foreigners are subject to tax on immovable assets that they own in South Africa, meaning a property will be an immovable asset. So the foreigner will need to account for capital gains tax should they sell off that property one day, and on the rental income earned from that property, 50% of that will obviously be for the foreigner's account, and they will need to declare that on their side in their tax return in the foreign country.
Right. Thanks for clarifying. Yannick, if you do have any more information or you want to chat to us, we're more than welcome to help as well. Great, Fred. So let's carry on. In terms of the DTA, and we're going to use that example that you took of Denmark. So essentially, if you were a Denmark investor, from what I'm understanding correctly, and just clarify if I'm wrong here, but the dividends withholding tax in South Africa is 20% for an individual, and if you're from Denmark, 15%. Is that correct for an individual?
Correct. Yes.
Correct. So a foreigner from investing from Denmark would pay less dividends tax than a local South African individual.
Yes, correct. Only
difference
15%.
Between the 20 and the 15%, so a 5% difference.
Yes, correct. So looking at the example, everyone would think, why am I not investing via a local company? So as you said, setting up the structure has costs, as well as being compliant. So compliance is unfortunately quite an expensive exercise. And it all depends on the need of that investor. So if someone is just investing in this property company via a local company to get past the dividends tax, that dividend is still trapped within their holdco. So if they ever need to access that cash, they'll anyway need to declare a dividend to themselves, which will be the ultimate beneficial owner. And then that will trigger again the dividends tax.
So that's what's important, that whoever is running, if you do have an investment company that you are using to purchase properties, make sure that that company is well run. Fred's obviously on the line, and that's what they do. I'll pop his details, at the end of the webinar, and you guys are more than welcome to chat to him if you need accounting or tax-related services, or you want to register a company. Obviously, we provide all of that in terms of our co-ownership offering to our investors. We run the property company, we do all the asset management, we have the directors meetings, and we do everything on behalf of the investors and ourselves, because we obviously invest alongside our investors in all these properties. So we manage those companies, and Fred's company, We Balance, they provide the secretarial services, company secretarial services to those companies. Thanks, Fred. I think we've covered everything on dividends tax and dividends tax agreements. I do have a question. What if one of the countries where someone is investing in doesn't have a dividends tax agreement with South Africa? So it's not on that list of companies with an agreement. What happens then?
Then we'll revert to the South African tax rules, because there will not be a declaration form that can be completed that states this is the double tax agreement rate. And so for the Neighbourgood company to still be compliant, they need to withhold then the South African tax rates on that dividend.
Okay. And that would that same thing apply if the person was, registered in if the person was residing in one of those countries but wasn't a registered taxpayer in that country, then we would also have to withhold the South African tax, which is a 20% dividends withholding tax. That's right.
Yes.
Great. Thanks, Fred. We can move on from here.
Okay, so basically trying to make this a bit more practical, specifically in the fractional ownership model of Neighbourgood. As you can see, the dividends tax rate, it's very difficult to tell before the time. So the return projections that were done on the Neighbourgood model, it took into consideration all the taxes that needed to be paid by this property company, being the income tax and the capital gains tax, but it did not account for the dividends tax, as that's not possible to tell. It all depends on the investor. So the return projections was all done before dividends tax. Maybe just something to take into consideration when you look at that.
So in terms of the models that we provided, and there's obviously a full investment pack that we've got in terms of our co-ownership property. If you do need a copy of that, you haven't got a copy, please reach out to me and I'll send you all the details. But in terms of that, in terms of the net projections and distributions to shareholders, the taxes that we've allowed for, Fred, and just keep me accountable here, it's taxable income in terms of the company's tax, capital gains tax in terms of selling the asset is being accrued for. The only one that hasn't is dividends tax, because we are not certain, depending on how you invest, whether you're an individual, a company, or trust, those rates would change.
Correct, 100%.
Perfect. There's just a question that Piers posted, but I think we can answer it fairly quickly. If the shares are bought by joint investors, two individuals, there is no difference in how the dividends tax works, except that the amount declared to each individual is 50%. That's correct, right? If they were assuming they were 50% shareholders each. And then we look at the capital gain. When you sell the investment, the gain would be split to each individual, and there'd be an inclusion applied to both on the gain. Correct. Depending on your shareholding. So if you were 50-50, 50% of that gain would be for yours, and then 50% would be the other individuals.
Correct. And in that specific example, we're looking at a shareholder 1 and shareholder 2 there. shareholder 1 can sell its shares off without shareholder 2 having to do the same, which would then obviously shareholder 1 has got its base cost, the cost that he paid for the shares. He's getting his proceeds, so the amount that he's selling the shares for, and that gain will be subject to capital gains tax for shareholder 1. But shareholder 2 did not sell anything, so they will just remain as a shareholder.
Perfect. So yeah, they wouldn't have realized their capital gain at that point, so they wouldn't be liable for capital gains tax at that point, the one not selling. Perfect. Thanks, Fred. Let's carry on.
Yeah, and then I think it's important to note that shares held in this property company would constitute a capital asset, except if you're a short-term share trader, but I don't think this model allows for something like that at the moment. So any shares held is also a capital asset. So selling that share would attract capital gains tax.
So, I mean, that's actually just happens to be, we've had that question now posted, which is great actually at this point to illustrate this. So the capital gains tax is allowed for in terms of the company projections. We've assumed that in terms of our ownership offering that the property is sold within 5 years, at the end of 5 years, and that you realize that return. If you sell your share prior to that, the property being sold, you can still realize a capital gain that you have in terms of your share that you own. Fred, just talk us through that and that specific situation.
Yeah, so let's say you purchase your share for 100,000 Rand. 3 years down the line, you decide to exit the structure. So at that time, you'll need to get a buyer for your share. And let's say you get someone willing to pay 120,000 Rand for that share. That 20,000 would be a capital gain. So individuals, they do have a 40,000 Rand free each year. So in this current example, if it was an individual who sells his share for 120,000 Rand, which he paid 100,000 Rand for, there would be a 20,000 gain, but that would still form part of the 40,000 that's for free each year. So if we bump that example up to, let's say, they're selling it for 180,000 Rand, they would then attract the 80,000 Rand profit on that, minus the 40,000 that's for free each year, meaning there would be a 40,000 Rand capital gain, which would then be included at the inclusion rates. If that makes sense.
Perfect. It makes sense to me. If we haven't answered or you need more questions, again, please keep us accountable here. Please keep us on our toes. Please send us messages. Thanks for all the questions, by the way. We really appreciate it. We want people to ask as much as possible and get what they can out of the session. That's our goal here with this. So please ask any questions. Again, it doesn't matter how small they are. We'll try and answer. If we don't know, we'll get back to you. Or if it needs some expert advice, we do have access to someone who's sort of consults to foreign investors as well if they've got tax questions in their specific jurisdiction. But the information that we're putting out will more than likely answer most of your questions.
Yeah, Sinj, I think that's.
Thanks, Fred. So you pretty much run us through all the different aspects in terms of a local investor, a local company, a foreign individual, and a foreign company. And then your slides will make your slides available to everyone who's registered for the call as well, just to illustrate those points. Anything else that you want to add, Fred?
Since I think most potential investors would have probably seen the foreign and local investor structure sheet. So just quickly on that sheet, someone reading that sheet now that attended the session, it'll hopefully make more sense to them. But on that sheet, there's 3 specific blocks where we cover the dividends tax, the capital gains tax, as well as the income tax implication for various structures. Maybe just something to mention, where we have an individual in the structure, you'll see that we said the tax rate is 18% on capital gains. That's merely because the the most expensive tax rate for an individual is 45%, and the inclusion for the capital gain is 40%. So the effective tax rate, the worst case effective tax rate will be 18% on your gain. So that's why we've just disclosed the worst tax, because once again, we don't know how much income that potential individual has already earned.
Thanks, Fred. Those slides will be available, so anyone who wants to have a look at that, Fred's put some detail into those slides, and if you need them, reach out to us. The email address is on the first message in the chat, invest@neighbourgood.co.za. Get in touch with me and my team, and we'll give you any information you need. Fred, specifically in terms of your guys' services, if people are looking for accounting and tax advice for their own companies, or want to register a company, or have some compliance or bookkeeping functions, what's the best way to get in contact with you and your team?
Yes, so we focus on accounting and tax matters, as well as company secretarial. And the best way to get in contact with us is via an email. So we've got an email address which is info@webalance.co.za, and you're welcome to send an email there, and someone from our team, most likely me, will get in contact with you, and we can set up a meeting. Most of this structures are very specific to the needs of the investor. So it's difficult to get a one-size-fits-all answer to something. So yeah, if we spend some time and get to know each other, we'll most probably get the best structure.
Thanks, Fred. It's been great to have you with us, and thanks again for your time in joining us for the webinar. We appreciate your help tremendously, as always. You're always super helpful, and you're always a call away, and you deal with multiple calls from us. Often when it's audit time, there's lots of back and forth and questions around is this a capital expense or operating expense? And we have lots of questions around that to make sure we reach the right conclusion for those financials. Thanks everyone for joining us. We do have a couple of things just before we end off. Our co-ownership offering, our Romney property, was a beautiful little 10-suite property in Greenpoint. We have also run a webinar specifically on Greenpoint, which we can send to you. If you haven't seen that one, it'll be on our YouTube channel as well. Please take a look at that. It's a beautiful little property. We are closing the first round of investment on the 3rd of September. So there are some shares still left. So if you are interested, you can get in touch with us. And there's an option to book. There's a calendar link again, like I said, to book a call with me, and we can go through the aspects of that investment. We will be looking to launch another property before the end of the year. We've got 2 properties that are busy in renovation at the moment. A nice little one in Camps Bay, some amazing views. And then we've got one in Franschhoek as well, and a couple other things that we're looking at doing. Murray, our CEO, he would have loved to be on the webinar today. He'll be on the next webinar. He's actually in the US at the moment, looking at the first properties in the US, which we will probably only be able to offer on co-ownership in the new year, but we'll be taking on management post the end of this year, towards the end of the year. Our team is already on the ground on that side, which is super exciting for us, and we'll get in touch soon. Our investment portal is live, so you can transact directly on the portal. You just need to click on the invest button on the top of the menu, and that'll take you to an option to register on the investment portal. And you can invest directly from the portal and take up your shares directly from the portal. If you've got any questions, again, contact details are there. And then a reminder on our next webinar, we're switching it up. It'll be moving away from investment and tax and math and all those things. And we're going to do some cool stuff around what to do in Cape Town with summer approaching. So we've got a locals guide to staying in Cape Town, very applicable for nomads and remote workers looking to come to Cape Town, specifically if it's for your first time, but I think you'll get a lot of benefit out of it, even if you've been to Cape Town before. The team from Local Knowledge, they have scoured the city and turned over every little stone to find the best possible places for you to be in the city and how best to get around. Just a super important information session for those looking to come to Cape Town, spend some time in this beautiful city. Fred, George is also very beautiful, but we have advice towards Cape Town.
Yeah, no, look, it's always a pleasure to go visit Cape Town. I mean, it's a lovely place. I might even attend your Insider's Guide. I mean, there's so many places.
Perfect. Perfect. Thanks, guys. Just before we end off, we'll just open it up just for some final questions. If you do have any other questions, just pop it in. Otherwise, we'll end off and allow everyone to enjoy the rest of the day. Hopefully, I see the weather is turning a little bit, so it should hopefully it gets more sunny. Perfect. There's a question on the YouTube channel. I see someone has posted it on there. We're going to be spending some energy on the channel as well. So we'll be putting out more content. We're going to be putting out property highlights as well. Murray's always looking at properties, and we're going to put out some content around his search for value. Thanks, guys. Let's just see if there's any comments popping up, and then Fred will leave you to get back to what you do best.
Thank you, St. John. Yeah, thanks for the opportunity to present.
Perfect. Fred, why don't you just pop that email in the chat that they can contact you, and maybe a contact number as well, just
Sure.
so that they have that.
Yeah, so that's basically the email address, and there's our office number as well, and they're welcome to ask to speak to Fred, and yeah, I'll gladly assist.
Great. Thanks so much, Fred. Thanks again for your time. Really do appreciate it. And for everyone else, just a reminder that you will be sent a recording. So if you missed anything, you want to go back, we'll also check all the chats in case we've missed someone. We'll see if there's a question that we still need to answer. We'll be in comms with you. And yeah, otherwise have a great day. And a final reminder that we are closing the first round of investment for our ownership property, which is our Romney Street property, on the 3rd of September. Thanks, everyone.
Okay.
Bye-bye.
Bye-bye.